profit margin of Amazon is 6.6%, whereas that of Walmart, it is only 1.8%. Why is it so that Amazon is doing almost 4 times better than Walmart? The answer actually lies in deep diving into the financials of these companies and analyzing their profitability ratios. Profitability ratios actually help in determining the company's ability to generate income or profit against the expenses it incurs. So some of the most important profitability ratios include the gross profit margins, operating profit margins, net profit margins, return on total assets, return on equity. So this is basically the topic of our day. Hi all, my name is Dheeraj Vaidya from wallstreetmojo.com, the most authentic place to learn finance and accounting. So without wasting much of your time, let's get started. What is gross profit margins? Gross profit margins is a part of the ratio analysis framework and it comes under the operating category. Here we will be discussing 3 margins like the gross profit margins, operating profit margins and the net profit margins. But in this video, we'll be discussing only one, that is the gross profit margins. So in order to fully understand what this margin is, it's divided into 2 parts. The first part is the gross profit and the other part is the sales. So what is gross profit? Gross profit is, let's say as a company, if you've done any sales. So whatever is the cost of direct sales, right? The cost of direct sales, once you deduct that cost of direct sales, you get gross profit. So I'll explain that with the help of an example. Let's say, you've done a sales of 1,000. Okay. So there would be cost of direct sales, like some cost will be associated with selling process as well as procurement of raw materials. So what are the costs that can go under direct sales? It could be the raw material cost, could be packaging cost, distribution cost, labor costs, and any cost which can be directly associated with that sales process will be the cost of direct sales. Okay. So if you have the sales as 1,000, and let's say if your cost of direct sales is, let's say 500, your gross profit is defined as sales minus the cost of direct sales. Okay. So that will come out to be 1,000 minus 500. This is 500. So any cost which is direct cost needs to be deducted, and that will be called as cost of direct sales. We also call this as cost of goods sold, COGS. Okay, so it is also called as COGS, cost of goods sold. So now that we know what is gross profit, the formula for gross profit margins is very, very simple. I'll show you the formula. The gross profit margin formula is gross profit, the one which we calculated just above, and the revenues. Revenue is nothing but the sales numbers. Okay, so in this case, what do we have? Sales as 1,000 and gross profit as 500. So what do we have in terms of gross margins or gross profit margins? That comes out to be 500 divided by 1,000, that is 0.5. So when we convert this into percentages, we get this as gross profit margin as 50%. So that's how gross profit margins is actually calculated. And its interpretations, we'll just look at it in a moment. Let us now look at some of the nuances of the gross profit margins. So I'll just copy the same example. So where we got the gross profit margins here. So let's say there are 2 companies. This was company A. And then there is company B. Okay. Then there's company B that has gross profit margins of, let's say, 58.3%. So what does it tell about, which one is better? Of course, the one that is generating higher gross profit margins will be better, right? So in this case, when we are talking strictly about these 2 companies, between company A and company B is generating higher gross profit, and therefore it results in higher gross profit margins on a per dollar basis. Gross profit margins of company B is 58.3%. So that's much higher. Now, having said that, you need to be cautious about the fact that both these companies should be from the same industry. So you cannot compare, let's say if this company A is in retail and the company B is in automobile. You cannot say that company B is doing better and company A is not doing better, because they are in the different unrelated industries. So they have to be in the same industry altogether. Only then can you compare it, right? So some of the industry where you will find the very high gross profit margins could be easily like hospitality, hotels, restaurants. These are the industries where you will find typically a higher gross profit margins, somewhere around 75%. Maybe in restaurants it will be around 65 odd percent. So this is typically higher because if you look at the way they are placed, the raw material cost for them is not high. For a hotel industry, if you look at for a hotel, they have already invested a lot of money in building the hotel, right? So for them, the raw material is the extra cost which they have to bear when the customers check in, right? Or the food costs, etc. So that's why the gross profit margins for such industries is very high. Now compare this with, let's say, another, for example, retail or auto services, for example. They would not have a very high profitability margins. Somewhere around 20-25 odd percent will be the gross profit margins for them, because in this case what happens is that the raw material cost essentially is a very high cost altogether. The raw material cost, the labor cost plus labor cost is kind of very high. So that's why such industries actually show a very low gross profit margins. So that's one thing which I wanted to actually share with you. Another important aspect of gross profit margins is that sometimes when you look at the annual reports, there are certain expenses which are not direct expenses, direct cost of sales. They're like indirect cost of sales. One example which you will definitely find in some of the annual reports is the depreciation expense. Okay. Now, depreciation expense in some SEC filings it's reported as a separate number, but in some of them it is actually included. So it's included in the cost of sales, or it's also included in the purchasing cost or the raw material cost, different types of costs. So you have to read through the annual report and find that out. So let's say in this example, I'll just remove the company B for the sake of convenience. So let's say there is a depreciation expense which this company A has included, and that was 100. Okay. So this is the amount that was already included in the cost of sales. So 500 includes the depreciation expense. Now, is depreciation expense a direct expense? No, it is not a direct expense. It's basically an indirect expense. It should come below gross profit, but it is because of the way the company has disclosed it. They have included it as a depreciation expense. So in this case, what you need to do here is you need to exclude this from cost of direct sales. Okay. So what this means is that your cost of direct sales was 500, that included the depreciation expense. You need to remove this 100. So your cost of direct sales will become 400, and your gross profit then jumps to 600, because this is the correct picture. It should not include the indirect expense. So that's why gross profit comes out to be 600 and the gross margins actually increases to 60%. So that's how you need to understand gross profit margins. So when you're comparing 2-3 companies and trying to understand what is the gross profit margins between the two, you need to also understand these subtle differences, okay, whether they are included or not. If they are, you have to exclude it from the calculations. All right. So I hope you understood what is the gross profit margins and why they are high or low for some of the industries, and which kind of cost should be included and which should be excluded from the cost of direct sales or COGS. What is operating profit margins? Operating profit margins is a part of the ratio analysis framework, and it comes under the operating profitability category. In our last video, we discussed about the gross profit margins, but in this video, we'll be discussing the operating profit margins. But before we calculate the margins, we need to really understand what is the operating profit as such. Operating profit is defined as the profit that the company generates from its core operations of the business. So first you need to understand what is the core operations of the business. So say for example, if the company is into the business of selling coffees like Starbucks, okay? So they're selling coffees, that's the core operations of the business. So all the income that, let's say, Starbucks generate from let's say investments in stock markets, that will be unrelated, right? It is not core operations. So that will come as a other income. So we will not be including those incomes which are not related to the core operations of the business. Only the ones which are directly related has to be included. Now, how do you find operating profit? Operating profit is the profit that is generated from, as I said, core operations. So basically, when we look at the income statement, we start with sales, right? And all the direct costs, which we call it as cost of goods sold, is deducted, right? So direct costs, or we call this as COGS, right? So that when we deduct, we call it as gross profit. Okay. So after the gross profit is deducted from this, we have all the indirect costs or the indirect expenses. Indirect expenses are like the admin expense, okay, rent expense, salaries, maybe advertisement expense. All of these are like indirect expenses but have to be incurred in order to generate sales, right? Because think of rent. The company may have a headquarters where the management does its work, so the rent has to be paid. So it is indirectly related to the sales, right? So when you deduct all of these indirect expenses, we get what is called as the gross profit. So we also deduct, please remember, we also deduct the depreciation and amortization expense as well here, because this is again a kind of an indirect expense. At the end of the day, in order to generate sales, you have to invest in machineries, plant, equipment, etc. So the cost that is apportioned across the years is kind of an indirect expense. So that needs to be included as well. So once we deduct all of these items, what we get is the operating profit. All right. So I hope you understood what operating profit is. Operating profit we generate by deducting direct costs as well as indirect costs, okay, from sales. And the indirect costs include admin expense, rent, salary, advertisement expense, depreciation and amortization, and there could be many others too. So once we have the operating profit, finding operating profit margins shouldn't be difficult. How did we find the gross profit margins? Gross profit margin was gross profit divided by sales, right? So how can we calculate the operating profit margins? It will be operating profit divided by sales. So that's how the formula looks like for the operating profit margins. So here is the snapshot. Operating profit divided by net sales. Remember that net sales or revenue, it's one and the same. Here it is multiplied by 100. You can actually in Excel you can directly put that as a percentage sign. All right. So this is how you go about calculating the operating profit margin. Let us now do quick calculations to understand how we can go about calculating operating profit margins. Okay, so just move this a bit. So let's assume that sales is 1000, cost of goods sold is 500. So we will get gross profit as 500, right? So now it comes to the indirect expenses. So indirect expenses are divided into various types. So we will assume that these are the ones which we have in our case. Admin expense, let's say 50. So these are some random numbers which I am putting right now. Advertisement expense, let's say it's 100. Depreciation and amortization is another 100. So how much this comes out to be? So this will be gross profit minus the sum of all of these indirect expenses, right? So this comes out to be 100. All right. So what we see is that the operating profit of the company is how much? Operating profit is 100 and operating profit margins will be 100 divided by your sales. That will be 0.1, that is 10%. How much is the gross profit margins? Gross profit margin is gross profit divided by sales, that is 0.5, that is 50%. So as I said, do remember that there could be a case where you will note that before the operating profit, items like other income or other expenses are included. Okay, so if that is the case, then you should not include that, you need to exclude that. All right, so let's say if in our case other expense was given as 50. Okay, so if other expense was given as 50, we should exclude that. Had you included that, your profit margins, operating profit margins would have reduced further. And again, it is not giving the correct picture, because when we talk about the operating profit margins, we said that the operating profit is from the core operations of the business. And if it includes other income, then that will not be the right thing to do. So we have to remove this. So ensure that it doesn't come into the picture and you get the right setup. What is net profit margins? Net profit margins is a part of the ratio analysis framework, and it comes under the operating profitability category. In our previous videos, we learned what is gross profit margins and operating profit margins. In this one, we'll look at what is the net profit margins. So in order to understand what is net profit margins, you need to first look at what is net profit. So it's very simple actually. And if you look at the flow of the income statement, you will get it soon. So let's look at the flow of the income statement. It starts with sales. And while we calculated the gross profits, we deducted COGS or the direct costs from there in order to get to the gross profit, right? So all the direct costs, when we removed from sales, we got to the gross profit. Then the second we discussed was the operating profit. And for operating profit, we deducted all the indirect expenses like selling, general and admin expenses, then the depreciation and amortization expense. So we deducted these indirect expenses to get the operating profit, right? So how is operating profit calculated? Once you arrive at the gross profit, you deduct SG&A expense and depreciation and amortization expense. And if there are any other indirect expenses, you also can include that. So once you deduct these two from this one of gross profit, you get the operating profit. Now from the operating profit, there could be other income and expenses which are leftovers, right? So there could be other expense, other income. There could be interest expenses. Interest expenses could be from the debt, the company may have taken. And then there are taxes, right? The taxes that you pay to the government. So let's follow a logical flow of the income statement. From the operating profit, you could have this other income and expenses. And then you can also have this interest expense. Right? So what do we get is earnings before taxes, or EBT, earnings before taxes. And from the earnings before taxes, at a certain tax rate, you pay the taxes, and what you get is the net profit. Okay, so this is how your net profit comes into picture. So remember that this net profit also includes all the recurring and the non-recurring items. Recurring means that happens every year, and the non-recurring items are the ones which happens once in a year or maybe once in a while. So those are not a part of the core business. So that also can form a part of this, and net profit includes that expense or income. So once you get the net income, the net profit margins would be just the net profit divided by your sales, right? So the formula is pretty straightforward. You calculate the net profit and you divide it by the sales, the top line number, and you multiply it by 100. Or if you're using Excel, you can just directly convert it into percentage. Okay, so this is how you actually go about calculating the net profit margins. Let us now do a quick calculation of net profit margins here, since we have the income statement flow, and I'll put some random numbers here in order to get to the final calculations. So let's say sales is 1000, cost of goods sold is 400. So we get gross profit as 1000 minus 400, that is 600. SGN expense, selling general and admin expense, let's say it's 100. Depreciation and amortization 50. So we get the operating profit as 600 minus 100 minus 50, that is 450. Other income and expense, let's say it was expense, so let's say it was 100. Interest expense, let's say it was 200. So how much is that? Earnings before taxes, EBT, that is 450 minus 100 minus 200. Okay, so this comes out to be 150. Let's say tax is at the rate 40%. So we get this multiplied by 40% will be the taxes. So it is 60. So the net profit comes out to be 150 minus 60, that is 90. Okay, so first step was to calculate the net profit, and the second step is, in order to calculate the net profit margins, it is net profit divided by sales. So that is, net profit is 90 and sales is 1000. So it comes out to be how much? This is 9%. Let us now discuss the net profit margins of some of the sectors. Earlier we had discussed about the hospitality sector, and we also discussed about the retail sector, I think auto services and restaurants. Okay, so we have discussed a couple of sectors when we were looking at the gross profit margins. How much was the gross profit margins of this sector? I think for hospitality it was around 75%. Retail, it's generally around 20%. Auto services, again, it's around 20%. In restaurants, it's around 70%. Now, let's see how the net profit margins look like. Okay, so hospitality on one side, on the gross basis, they were generating 75%. But on a net basis, if you look at, they are hardly able to generate around 8%. Okay, so that's a very drastic difference between how much gross margin is and how much net profit margin is. This is primarily because in hospitality, if you look at, lots of costs are spread across spending in hotels, right? And generating they have lots of capital assets. So if you consider depreciation, amortization and other interest expenses, because they are also heavy on debt, the net profit margins actually reduces significantly. If you look at the retail sector, it was 20% of gross margins and they are able to generate around 5%. So retail as a sector actually is a wafer thin margin business. So it's a high volume and low profit margin business. If the volumes are really low, then it can easily go into red. So that would become a loss making unit altogether. For auto services unit, of course, gross margins was very low because the raw material cost and the labor costs are pretty high. But they are not too much dependent on debt, and there's not much into the capital assets. So depreciation and amortization cost for them is also pretty low, and they generate a healthy 12% profit margins, I guess. So that's how the difference is. On one side 75% and they're able to generate only 8%. But in auto services, you can see gross margins is 20%, but net profit margin is much higher. It is at 12%. For restaurants, again, it's similar to hospitality. They generate very high gross profit margins, but at the net level, they are around 15%. So please note that these are some of the average numbers. So if you pick some industry, some company, they might not match. But yes, these are broadly how the industry and the sectors would look like. What is return on total assets? Return on total assets is a part of the ratio analysis framework and it comes under the operating profitability. Return on total assets is kind of defined as how much amount of profit the company is able to generate by utilizing its total assets. The total assets basically consist of two parts, right? When we talk about from the point of view of balance sheet, it's divided into current assets, which is like account receivables, cash, inventory, etc. And then there is long-term assets, which consist of property, plant and equipment, goodwill and intangible assets. So how much amount of profit the company is generating by investing its total assets is basically the broad measure of what this is defined, how this is defined as. Okay, so when it comes to the denominator, we are pretty clear as to what total assets is all about. But when it is about the numerator, we say that profit, right, is on the top. So what kind of profit are we talking about? Is it the gross profit or the EBIT or the operating profit, or is it the net profit? So let's look at the income statement to understand this first. So we start with the income statement. We have sales, we have cost of goods sold. So what we get is gross profit. After gross profit, the expenses like selling, general and admin expenses are deducted. And then we have the depreciation and amortization expenses, right? So we get the operating profit or EBIT here. And then after the operating profit, we deduct the interest expense. So we get EBT. From EBT, we reduce the taxes to get the net income or net profit. Okay. So there are different definitions of profits, as I said. So there's net income, EBT, EBIT, and gross profit. So which one should you take is the question here. Now think of net income. What this actually denotes is that how much the company generates in terms of income after paying what the debt holders are expected to get by way of interest expense, right? After paying the taxes and all the expenses are accounted for. So if you look at the total assets on one side, total assets is equal to total liabilities, right? And what does the total liability signifies? It's basically debt plus equity, right? So if the denominator is total assets, which is equal to total liabilities, and it is basically a measure of funds invested from debt and equity point of view, the denominator is like that. The numerator should also be a measure which is pre-debt and pre-equity measure. What I mean by pre-debt, pre-equity measure is that in the numerator also, you should not, let's say if we consider EBT, this is basically after deducting the interest. So this is paid to the debt holders, right? Right. So you cannot take EBT because you have already taken care of the debt holders. When in the denominator there is the sum total of debt and equity, you have to take a measure which is just before interest. So this number, that is operating profit, is the most suitable measure to take, to be considered in this formula as such. So we take operating profit as a measure which is pre-debt and pre-equity. So operating profit divided by total assets is the formula for calculating return on total assets. So here it is, return on total assets, operating profit, EBIT divided by the word average of total assets. So remember, we have been discussing this a couple of times. Average of total assets is required because when we consider the balance sheet items, it is at a single snapshot. So during the year, a lot of activities, purchases or selling of assets might have happened. So in order to smoothen that numbers, we must consider an average of the two. So from the start and the end, we take the average of the total assets. So if you consider this formula, it's fairly straightforward, but the important thing to note is that why we take operating profit, and operating profit being a pre-equity and a pre-debt measure, that's the most suitable type of profit that we should take as with respect to the total assets. So when we look at the final formula, it's something like this. In the numerator, as we discussed, is the operating profit, and in the denominator is total assets. But here we take the average of the total assets. So average of the total assets is important because the total asset number is a balance sheet item. So you remember we had discussed this many times, that when it is about the balance sheet item in the denominator, you need to take the average so that it smoothens the whole total assets, what has happened during the year. And why is that so? Because balance sheet items are like the snapshot items at a specific point in time. So usually we get the start of the year balance sheet and the end of the year balance sheet. So we really don't know what has happened during the year, right? But if you look at the numerator, operating profit is for the full year during the year, right? So in order to take the better measure of total assets, we should not take just a single snapshot, but we should take an average of the two. So that's the most important thing. And as I said, the formula is not actually very difficult, but the important thing to understand is that operating profit needs to be in the numerator because it's a pre-debt and a pre-equity measure. So let us now calculate the return on total assets and see how it is done. Okay, so I'll use the same income statement format that we have it here. So let's take a hypothetical example. Sales is 1000, cost of goods sold is 300. So we get the gross profit as sales minus cost of goods sold. Selling general and admin expense, let's say it is 200. Depreciation and amortization expense, let's say it is again 300. So the operating profit will be 700 minus 200 minus 300. So that comes out to be 200, right? So for the denominator, we need the average total assets. So let's say total assets at the start and the total assets at the end. Okay. So if it was at the start, let's say it was 500 and then it changed drastically to, let's say, 1000. So it became 2x of the start. So we'll be taking the average number as we discussed earlier. So the average is average of 500 and 1000, and that comes out to be 750. So what is our return on total assets? Return on total assets is equal to operating profit 200 divided by 750. That is the average total assets. Okay. So this comes out to be 6.7%. All right, so whether this is good or bad, it depends on whether you want to compare it with the industry or some other company. You cannot compare, obviously, as we have discussed many a times, you cannot compare a software industry with a capital goods industry, right? So if this is a capital goods sector company, you have to compare it with the industry peers itself, okay? And another interpretation of return on total assets is that obviously the higher the return, better it is for the company, right? So this means that the company is able to utilize its assets in a much better way in order to generate higher operating profit. So some company that has a lower return on total assets, we'll assume that that's not doing better comparatively, right? What is return on total equity? Return on total equity is a part of the ratio analysis framework, and it comes under the operating profitability category. What we understand by return on total equity is that how much the company is generating in terms of net profit or net income on its total equity. So say for example, if the return on equity of a company is, let's say, 15%, what does that mean? It simply means that the company is generating $15 of net profit out of the investment of $100 of shareholders' equity. So 15% as ROE, or the return on total equity. Now, important thing to note here is that we are talking about the total equity and not the owner's equity. Okay, there's a difference between the two. We'll come to return on owner's equity in the next video, but here let me define what total equity could mean here. So what happens, when you are looking at a consolidated balance sheet, the shareholders' equity or the total shareholders' equity comprises of two types of equity. One they will call it as shareholders' equity, and the other one is called as minority interest. Okay, or this is also called as non-controlling interest. Okay, so when we look at the total shareholders' equity, we have to consider both. Okay, not only the shareholders from the company, but also the minority shareholders, so that both the item needs to be included. We'll be doing this example in Colgate, because Colgate does have this kind of a setup where they do have this non-controlling interest. So we'll look at, how it is calculated in that context. But let's say for example's sake, let's assume a very simple one. And here is the formula first. Return on equity is basically net income divided by your shareholders' equity. So here what the shareholders' equity would mean is we'll be taking the average of the shareholders' equity. Like in all the ratios that we have done until now, if it's a balance sheet item, we take the average of the numbers, shareholders' equity at the start and shareholders' equity at the end, and we do the average because we know that balance sheet items are at a single snapshot, and taking the average smoothens out the numbers, and therefore the ratios come out to be much better for the interpretations purposes. Okay, so we'll take the average of the total shareholders' equity, and in the numerator we'll take the net income. Okay, so let's now do a quick calculation and look at how return on total equity is calculated for a hypothetical example. Let us now take a hypothetical example to calculate return on total equity. So let's assume there's a company whose net income is let's say $100 and shareholders' equity at the start is, let's say, 200 and at the start is 200 and at the end it is 500. Okay, so as I said, the shareholders equity numbers has to be the average of the two. So let's take the average shareholders equity would be 500 and 200, the average of the two. That comes out to be 350. So the return on total assets, total equity, this is equal to 100 divided by 350. That comes out to be 28.57%. So how good or bad this is? Obviously, you will have to compare this with the industry to understand whether they are above the industry peers or below the industry peers. Okay. So just to give you a perspective of some of the return on equity numbers from the other industries is like, say for example, retail. Retail has a return on equity of around 35%. So it's pretty high for a retail sector. So those companies which are generating, let's say, 28% and operate in a retail sector, they are actually below the peers. Okay, but let's say if we talk about capital goods, okay, capital goods generate around 18% of return on equity. So that's the ballpark number. It would be 18 to 20%. But let's assume if this company was in the capital goods sector, then obviously this was much above the 18% as a benchmark. So this would have been really good number to look at. Likewise, if you look at other industries like financials, the average return on equity in that sector is around 10%. Another example could be utilities. They have even a lower return on equity number that comes out to be around 8%. So these are just average numbers out of US based companies. So these numbers may change depending on the specific company if you have picked. So let's now discuss how the calculation of return on total equity happens in Colgate. And that's where we will get to know more about the inclusion of minority interest to the non-controlling interest as such to calculate the return on total equity.
I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future videos, then you may do so by writing about it in the comments section. Also, we come up with interesting videos on finance and accounting topics regularly. So if you haven't subscribed to our channel yet, then please do so by clicking on the subscribe button below so that you can get the notification about our latest videos as soon as we release one. Thank you for watching. Have a nice day.